So you can't just come in with every single multifamily assumption and say it's going to be a 3% year over year increase. It could actually dip and drop, right? Which
Yeah.
is why, your listeners should be looking for deals that have been owned 10, 12, 20 years by the same owner that kept them maybe $100 below the market. That's where the deals are going to be right now.
Welcome, my fellow Flow Masters, to another episode of the Cash Flow Authority podcast. I'm your host, Chris Jansen, founder of the Flow Authority. And this show is for high-performing professionals who did everything right. You've got the degree, you've got the career, you've got the income, but you just feel like there's another level waiting. And so here we explore how real estate can become that next challenge worth building so you can really take ownership of your future and start creating that life that you really want by design. So today we're joined by Reid Bennett, who's the National Council Chair of Multifamily Properties for SVN International and Senior Vice President at SVN Chicago Commercial. Reid is a Midwest apartment sales specialist, a premier commercial real estate coach, and the creator of the Multifamily Owners Blueprint. So Reid, welcome to the show.
Hey, Chris, thanks for having me on. Looking forward to it.
Yeah, you bet. Yeah, me too, man. Me too. So first question is just from a broker's perspective. Your company SVN, national leader in multifamily sales. What's the biggest operational blind spot that investors have when trying to scale their portfolios in apartments?
I'm trying to scale their portfolio. I guess the biggest blind spot would be, especially over the last 3, 4, 5 years, it would be to have assumptions that are extremely aggressive. Right, we saw that. So I've been selling apartment complexes and buildings since 2001, 2002 is when I started. Right, so the thing that happens is, as we've seen, everybody in this business has about 7-year to 10-year amnesia. They forget what happened during the last cycle, and so especially when the new syndicators get involved, they think, all right, the debt is 3.5, 4%. I'm going to be raising rents double-digit percentages every year, and that's what their assumptions are. I've seen all those assumptions come in. You have to be very, I would say, cautious. You can be cautiously optimistic in some of your underwriting, but locking in long-term debt rates has been one of the things that I've seen. People that did not do that are the ones that are getting in trouble right now. So I'd say make sure that your debt lines or is in line with what your hold period is going to be, and as long as possible, because as we've seen over the last 3, 4, 5 years, the debt markets can change dramatically and very fast.
So I guess how challenging is that? Because I know like a lot of my listeners are more, some of them are going to be more focused on the like smaller 1 to 4 units where they're used to a 30-year amortized fixed rate loan. So how does that differ on the commercial side?
So on the commercial side, we've had people that do bridge loans. We've had a lot of bridge loans to get into larger multifamily deals, which are very high interest rates, and typically they're 1 to 3 year terms. So a lot of the groups that got in with those thinking, okay, I'm just going to come in, renovate, raise the rents, and then cash out at a rate. And all their assumptions were what the numbers were, 3, 4% at the time for a 30-year, or longer term debt. 10-year really is probably the longest. But for the listeners that are doing the 4 and under, which is a fantastic way to start. I think it's the best way to get into commercial real estate or real estate in general, right? Because 4 and under is considered residential. And also 4 and under, you can utilize the other 3 units. If you live in one of the units that's owner occupied, you can use those 3 units as your income, the rents as your income. The best way to get into real estate, in my opinion, is to live in the worst unit of the 4, rent out the other 3. They're paying your mortgage, as I'm sure a lot of your listeners know. It's a fantastic way to do it. And then as soon as you get in there, I would move into, buy another one, lever that up, buy another one, move into that one. And just, if you have 3 fourplexes 3 or 4
Mm-hmm.
4-unit buildings that are paying for themselves, you're already financially free, in my opinion, depending on how much you spend.
Yeah. And then so if you're at that point, I mean, at what point do you transition, and how do you recommend transitioning over, from the 1 to 4 units to the commercial side? Do you sell those and trade up? I've heard people talking about that, trading up. But then I also see people trying to sell their portfolios, and then you got guys like me trying to buy those portfolios, and I see that people aren't biting at them,
Yeah.
and they don't have any leverage, and especially if they use a portfolio loan and they don't want to parse them apart and all this. So it seems like a hassle if that's the plan, but maybe I've never done it, so I don't know.
Yeah.
From what do you think?
Well, it depends on what your goal is. You mentioned a good point. How much equity do you have in those deals? Because if you have no
Hmm.
equity in them, it's not going to work to lever them up.
Yeah.
But what I would do to transition from fourplexes and eightplexes and 12s, if you're trying to go into, really depending on the market, and I'm here in the mid, I'm in Chicago, I'm in the Midwest, but we work with, I work with my council members all over. We have deals in El Paso, Texas, Syracuse, New York. We're working on another portfolio down in Alabama with another one of my colleagues. The thing that I would be thinking about when you're scaling,
Uh-huh.
it seems like 125 units is the point of an apartment complex that you can have a full-time manager and 1 or 2 full-time maintenance staff.
Okay.
Seems, depending, I mean, I'm talking, it might not be in a primary market like Chicago or Miami or LA, but it is secondary and tertiary markets. It seems like that 100, 125 is that point where you can have
Mm.
people, staff on there running it and scaling it. And to transition from a 4-unit, 8-unit, 12-unit into that, I would do it with a partner,
Mm.
somebody that's already done it, where you can say, look, I'll find the deal. Will you go in with me? Will you be my key principal
Yeah.
on the mortgage? I'll manage it. I'm already managing 4 fourplexes. I'll do all the sweat
Hmm.
equity. That's how I would get into a larger transaction from that.
Nice. Okay. Awesome. Awesome. Sounds good. So then, okay, so you make the transition, and then, what's the easiest lever to pull if you're trying to, boost your NOI, whether it's increasing income, decreasing expenses, both, what's the easiest lever you can pull?
Yeah, so you have to do both, right? So I've created this analysis tool called the multifamily matrix, and that is where we do expense audits to see, look, where can we cut these expenses and how do they line up with the rest of the properties in your market? And then can I get you a few contractors that we can reduce that number? Can we reduce your insurance premiums by utilizing an umbrella? Can we, do you need to protest your taxes? You have to do it from both angles, especially in today's market where the problem that we're seeing, and I think we will continue to see, is as distressed assets start coming to the market, which they are starting. It took a hell
Mm.
of a long time from 2023 when everybody thought there was going to be this flood of distressed
Mm-hmm.
assets when the interest rates jumped. Banks kind of held on to them. We've done over 560 BOVs of multifamily assets across the Midwest and various other parts of the country. And the last 3 years, lenders are just holding. They're like, I don't even know what to do with this. We're just going to kind of keep kicking the can down the road. They called it back in the day extend and pretend, or pretend and extend the loan. I think that stuff is going to start working its way through. So as that works its way through, the problem for current owners that are operating their properties at a high level, if they want to sell and these distressed assets sell right down the block from you or on the same street or in the same zip code, unfortunately, that's what the assessors, not the assessors, the appraisers are going to pick up when you go do a refinance. So that's what we're doing
Mm.
with a lot of the owners and operators of multifamily, is running them through the multifamily matrix so we can help them just juice their NOI so it's not a cash in refi, which is a
Mm.
horrible position to be in if you're an operator
Oh
of
yeah.
multifamily.
Sounds terrible. Yeah, for sure. Okay, so I don't know. You mentioned, right, these assumptions of C Do you see that continue? I always see like 3% rent growth. Like no matter what pitch deck I see, it's always like 3% rent growth or 2.5 to 3.5, kind of that range,
Yeah.
no matter the market. But obviously that can't be the same for every market, or
No.
you'd see the same appreciation in every market.
It definitely depends, because I also work with a lot of brokers. I coach brokers on a different platform, all multifamily brokers around the country. And what I'm seeing with the guys and gals I'm working with in the Sun Belt region, say Florida and Texas especially, is they've overbuilt, or they've built. It depends on how you're looking at it, right? So up here in the Midwest, a lot of people will say in the blue states where the politicians don't allow a lot of development, it's an exact negative effect on the tenants they're trying to protect. If you don't allow development, it's simple economics 101, right?
Makes sense. Yeah.
Supply and demand. If there's not a lot of supply out there, the rents go up. What we're seeing is when they allow development in the Sun Belt regions, Texas, Florida, I'm just picking on those two states because that's what I'm seeing a lot of.
Yeah.
The affordability goes up because there's, we're looking at deals in Florida where the market rents are dropping by $150 to $200 a unit. So what was a $25 million asset is probably now $18 million.
Wow.
Just with the same, and then you add in, you have insurance expenses that are going up. Real estate taxes are finally catching up to the ridiculous pricing because it's all in arrears, right? From the 22 era, 21, depending on what's going on in some states and how assessments are done. So that's the one thing, is you could have double-digit increases for 3 years, and then an insurance bill that triples, real estate taxes that go up, and then right now what we're seeing with a lot of the obviously gas, the diesel prices are affecting everything with multifamily, because how do you get the new kitchens and bath renovation material to your property? It's come from a diesel truck that is bringing it in there. So all these prices are coming up. They're trying to have inflation go down. Inflation's going to start running out of control. I mean, today it's May 29th, 2026. The other interesting part is there's going to be a new Fed chair that's coming in.
Yeah.
And it was supposed to drop rates. My guess is they're going to be increasing rates at the next Fed meeting, which is going to be totally
everybody's going to shit their
interesting.
pants. Yeah, it's just like
we're getting off on a tangent. I can go all day on this, but yeah, supply and demand. There are areas like what we were talking about where rents are dropping. So you can't just come in with every single multifamily assumption and say it's going to be a 3% year over year increase. It could actually dip and drop, right? Which is why, your listeners should be looking for deals that have been owned 10, 12, 20 years by the same owner that kept them maybe $100 below the market. That's where the deals are going to be right now. Where you can come in, yes, you can raise rents 5% on a deal that's $100 below market. But you can't do it on a deal that just sold 3 years ago with a syndicator or a buyer that is trying to show you that they had to raise rents and decrease expenses to make it work.
Yeah. I mean, this has to be related to this, but I mean, I just moved to Dallas from California, and I'm from Wisconsin. I've moved all over the place, so I'm from the Midwest. That's where most of my properties are, and I just like it for the cash flow, honestly, and I haven't had any issue raising rents either up there. So, but coming from California to Dallas, I was just shocked at how cheap. Like, I'm getting higher rents on some of my Wisconsin units than they're charging here in Dallas for like a newer build like I'm in right now. It's crazy. I'm paying $1,200 for a 1-bedroom apartment, but I just in a nice area though. It's not like I'm in the hood or anything. I mean, and that's got to have something to do with it. I know they're building like crazy out here. They're building like crazy, and I don't think they're stopping anytime soon.
No, it's supply and demand.
So
supply and demand. That same unit that you're in up in Madison, Wisconsin, would probably be $3,000.
Yeah.
Because they're not building enough in the Midwest, right? So
right. Yeah. Nice. Well, okay, so obviously geographically is one thing, but then there's also, the the lower affordable housing, lower income
Yep.
kind of types of properties versus market rate. So from a cash flow perspective, which model would you say is more resilient in today's economy?
Well, so we do both. I'm right down the middle. So some years, more than 50% of our deals are low income housing tax credit deals or project based Section 8. And then some years it's more on the market rate side. What the trend that I tend to see is when a market starts kind of dipping, the affordable side of the spectrum starts getting way more attention, especially with project based Section 8, where the government's paying one check for the whole building. You
Mm.
know, the government's always going to be printing money as it is right now, and it's going to be
Yeah.
paying those bills first. So those tend to be, and also markets like this where inflation's out of control and it's costing the average person $120 to fill up their gas tank. It's going to push some of those class C B minus renters into affordable housing.
Mm-hmm.
So it just depends. And so that's why we work both sides of the fence where oftentimes, and I'll tell you a couple things with that. We go to this National Multifamily Housing Council meeting in Las Vegas every year. And the last 2 years, we've had more market rate groups wanting to buy expiring tax credit deals because they can't make sense of the underwriting on market rate deals where owners and operators, the metrics are through the roof. They're raising rents in certain areas around the country on renewals. Everything's going fine, or those renters are not buying homes.
Mm-hmm.
So the metrics of multifamily in most areas around the country are pretty robust.
Nice.
And so buyers, which might be some people listening on your podcast, can't find deals that pencil out on the market rate side. So they're starting to look at expiring tax credit deals. But that's a
Okay.
whole nuanced industry that if you don't know what you're doing, and anybody can reach out to us anytime with a deal they're looking at, because there's a thing called a LURA, land use restriction agreement, that is the Bible of what you can do with that particular asset. And if you don't understand
Okay.
how to income qualify on those deals and how long the affordability component goes, you could be in a world
Yeah.
of hurt if you're buying a deal on a price per pound, which we're seeing.
Gotcha. Gotcha. And do you guys work with any size multifamily deals like a 12 unit? I mean, or is it pretty much like, 50 and above, or like do you have a minimum?
Yeah, so in my office here in Chicago, we have 54 brokers. My team, in particular, we work 50 units and above in the majority of
Okay.
the marketplace, but we also do have juniors that will work smaller assets. When I
Yeah.
started in the business, I was working corner walk up 12 units and above. And then we would even
Okay.
do, as areas became very expensive, we would even do center entrance six flats, right? Where they were 200 a unit. So it's still, and now some of those center entrance six flats in Chicago are probably 500 a unit, depending on where you are. It's
Wow.
just insane what the pricing has
That's
done
crazy, huh?
in certain areas. But yeah, so majority of the deals we're working are going to be 100 units and above. A lot of the secondary and tertiary markets, that could be $2 million. That could be $20 million, depending on what the rent. Everything in multifamily is a function of the rent you can collect, right? And we have a
Mm-hmm.
back of the napkin thing. If I'm looking in secondary and tertiary
Mm-hmm.
markets, I take the rent times 100, and that's a
Mm-hmm.
baseline of what you can pay per unit, right? So if it's
Okay.
$1,000 a month rent, it's $100,000 a unit that I look at. That's back of the napkin what I could pay. If it's an
One
older,
percent rule,
yeah, if it's
basically, right?
yeah, if it's an older asset where you're paying all of the heat as the landlord, I'm going to drop that down quickly. If it's a brand
Yes.
new asset where the tenants are paying all their utilities and there's not a lot of repairs and maintenance, that could go up quickly, right?
Yeah.
So that thousand
Yeah.
dollars a month rent could be 60,000 a unit, or it could be $200,000 a unit, depending on what the asset is, the location, and a couple other metrics. But you can you can understand that pretty quickly.
Yeah.
Analyzing a deal in today's market.
Nice. And if the owner is paying the heat for all the units, do you recommend rubs or are there other options, ways to do that, or what's your experience?
It depends, right? Because it'll depend on what that specific submarket and the comp sets are paying. So if you're paying the heat, if it's a centralized boiler system and you're in the Midwest, like I'm sure you have in Wisconsin, the
Yep.
gas bills can go pretty high. So if your tenants are paying $1,000 a unit and you're trying to rub back, you have to be very sensitive as to what they can leave your unit and go pay for, if they're heating their own in a newer building, the difference between your 1976 built building where you're paying the heat versus a 2010 build where it just depends. So you have to be very sensitive of the marketplace and how everybody's rolling that into their full rent payment.
Gotcha. Makes sense.
It seems like the RUB system works when you have, again, below market rents, and you can then transfer that over, saying, to the tenants, rather than increasing your rent to $150, we're going to implement this RUB system so everybody is responsible for their portion of the heat. That's sometimes more palatable for the tenant than a $150 increase.
Yeah.
But it's nuanced, and it's, property to property and market to market based on what everybody else is paying.
I mean, I also just see people just doing a flat fee.
Yeah.
Especially with water. I mean,
water
just a flat utility fee. But that way too, with the heat, it's not like they're getting spikes, in the winter. It kind of averages it out across the year.
Yeah.
But nice. So all right. So from a coaching perspective, what's the most expensive mistake that seasoned operators make when they get too comfortable? And you've probably touched on some of these items already, but just to really nail it on the head.
Oh man. Well, from a coaching perspective on that, because I coach brokers that are selling apartment complexes.
Okay.
So if I'm coaching somebody what they're getting comfortable with on the ownership side, I would say don't get too comfortable. Well, here's one thing that a lot of the clients that I sell deals to and for have done. When they buy a building, you want to start any kind of upgrades. I would do it to the common areas of the building that can be seen immediately by the tenants, right? Updating the lobbies, updating the hallways. If it's a garden style apartment, cutting out, the landscaping that is overgrown and really making things nice. So then you can, now you're going back and asking for an increase, $25, $30, $50. It's a lot more palatable when they see things going on. When you're responding to maintenance issues quickly. If you have maintenance tickets that are out there for 3 months, the tenants understand that, and then they're not going to be treating your property as well as they should when nothing is serviced.
Right.
I've seen owners where they're not fixing anything, and then we go and tour the property and show it to a prospective buyer, and the tenants are now saying, I've called on this, this toilet's been leaking. I've called on to see this, something's leaking from above. Nobody's come here. I mean, that's the worst, right? So being quick, address any physical issues with the property with your not falling asleep at that is I think a key aspect to how your property is perceived by the tenants and how they're going to treat your property moving forward.
Yeah. Yeah. I mean, definitely makes sense.
Yeah.
I'm now a tenant, so but I've been a tenant before. I mean, I remember, those types of things definitely, and I'll move if that's the case, because I mean, nobody wants that.
Exactly.
But
and if you're in areas like where you are in Dallas, you have to be hypersensitive to that now, because somebody is going to move quickly to a new unit. I mean, there's a cost to moving, with the pain. But if I can go from a landlord that is not taking care of my unit, not taking care of my needs, and go to a newer property down the street for the same value, I'm going to do that a lot quicker than if I'm happy with the current situation I'm in a 1985 vintage product down the street.
Yeah. Just a random thought. The only complaint I have so far at this place, actually, the maintenance is great. They come right away. They're really good.
Yeah.
But there's no security. When an apartment has like 400 units like this one, it just takes one bad apple.
Yeah.
And I mean, I'm in the middle of Dallas. So anyways, that's just something, after being here for a little over a month, I've had to call 911 twice.
Oh, wow.
And it's the same people, it's the same people both times.
And that's the tenants that are in the property with you, right?
Yeah. I mean, it's at least one of them. And then whoever they go party with, it's just kids being stupid on the weekends. But I initially didn't do anything. So I'm like, okay, it was one weekend. Kids are kids.
Yep.
Then it happened the next weekend. So then I notified, the landlord, basically the manager, and they're like, well, we don't have security. We don't have, we don't have after hours or anything. So really you just got to call the cops. So that's what I did. That's what I did. But we'll see. Yeah. Like I said, it's just one group, everything else. But anyways.
And it's tough because, you're asking about what's the blind spot, and it is tenant screening, right? I mean, you have to screen the tenants, but it's really tough.
Yeah. You get 400 tenants. I mean, people are going to fall through.
Right. If they have the right credit score, they have they don't have any evictions, and it's like, okay.
Yeah.
You don't know how loud they're going to play their music when they come into the, but that's why the management should be taking care of that quickly. Right. Because if the rest of the people don't feel safe, you have to get rid of, like you said, the bad apples very quickly, especially in this market.
Yeah, for sure. All right. So when it comes to negotiating the deal, and this I know is different for sure from single family and residential to commercial, big difference when you're submitting an offer. So what's the fastest way that a buyer can just immediately ruin their credibility when they're submitting an offer with a commercial broker?
So I would say the first thing would be earnest money.
Okay.
If your earnest money is not in line with the market as far as a percentage of again, your earnest money you have, and I'm also on another panel of investors that we go over deals on a weekly basis and look at what's going on and why did you lose this deal and what's going on. So if you think about this, buyers get worried about, especially new buyers, they get worried about having to front that earnest money immediately, right?
Yeah.
But you don't have to put your earnest money up until 3 days after a PSA is signed, a contract is signed, right? So you have, from the time you start negotiating the letter of intent, you can make that, and once that's signed, you usually have about 30 days before a PSA is signed. You can do a lot of due diligence in that time period before you have that money up. But you'll never get selected. Let's say you're doing $1 million deal and you're putting up $1,000 of earnest money or $5,000 of earnest money. You're going to get cut off right away if there's multiple offers. On $1 million deal, if you're putting up $25,000 of earnest money, again, it's fully refundable if you have a due diligence period in there and a mortgage contingency.
Yeah.
That's one of the things. If you overprice it, knowing that you're going to come back for a retrade, you get that. And if you get that kind of a reputation in the market as a buyer, it's a horrible thing to have a reputation of doing because brokers will not select. I know the buyers that do that in my marketplace. I could name 5 right now that do that all the time, that I'll never give them a deal.
So how do you, as a buyer, because sometimes that just happens, like you don't intend to retrade, right? But you do your due diligence and you're like, you start finding stuff in the inspections and whatnot. I guess as a seller, on the seller side, where do you see that as, oh, this guy's just retrading, he's an asshole, I'm never going to do a deal with him again, right?
100%. Look, there's 2 different retrades, right? There's, what I'm talking about there's groups that I call it sport retrading. They're just going to retrade to see how much they can get off the price because they know they overshot it and they're trying to nitpick and find things that aren't realistic.
Gotcha.
That's a different story than you put the deal under contract, your due diligence, maybe you have a phase one where you find an underground storage tank that's going to cost $60,000 to remove. That's a thing where you say, hey, look, Mr. and Mrs. Seller, this is what I found. This is an issue. My bank is not going to give me a loan for this one unless this is either removed or we get credit for this. You have to be transparent about legitimate latent defects that you didn't know about, the seller didn't know about maybe. If those things arise, you have to share that quickly. And sometimes the sellers don't want to know about it. And if they have a broker representing them, you can tell the broker, look, I will give you my reports. This is the situation. We have to address this somehow, otherwise I have to back out. You know? And if you have a seller that's like, I don't care, your contract says as is, where is, with all faults, I'm not doing a thing. All right, I'm out. Yeah. I mean, you have to make that determination. If it's a $5,000 or a $10,000 roof leak or whatever, you know, sometimes don't even go back to retrade that, because those are things that, of course, if it's an older vintage building, going to be a lot of, you know, these kind of things that are going to come up in the diligence. And if you're a buyer that just closes, no matter what comes up in that small, let's say it's under $15,000, $20,000, you'll get a better reputation in that market.
That makes sense. And again, I think that's another just distinction between, I mean, if you're buying 1 to 4 units, $5,000 issue with the roof, that could be a big deal, you know, it's because it's a bigger percentage of the purchase, right? But if you're buying a $5 million, let's say, property, you know,
of course,
small potatoes, right? So that makes sense.
But I mean, you're also asking, you know, up front for the disclosures, like, what do you know about this property, Mr. and Mrs. Seller, that I'm going to have to address? And if they don't share that with you, and then you go in and you find that this thing's been leaking for 6 months, you know, that's not the buyer's problem at that point.
Yeah.
Right?
Yeah.
But if it's a couple of shingles that are blown off the roof in a storm while you're under contract, come on, you know.
Yeah.
You have to make that determination.
For sure. All right, Reid. Well, hey, I appreciate your time today. My last question, you kind of answered this, I think. I mean, I think I know your answer, but it's just to make sure for you know, kind of the newbies who are, well, newbies on the commercial side, people who are maybe just going straight into commercial multifamily, or they're, again, transitioning from single, you know, residential over to commercial. What's your biggest piece of advice for those individuals?
That would be, I mean, if you're going from residential to trying to get over to more units in multifamily, I don't know if we said this offline or online, I would go for the 4 unit.
Yeah.
You know, I'd go 4 unit immediately, because 4 is the most amount of units you can have and still get a residential loan, which is very like a owner occupied residential loan. Right. And you can, again, use those 3 other units as the income, and those 3 other units, if you buy right, will be paying your expenses and your mortgage while you're building up equity in that building. That would be the first place I'd go as quickly as possible, because if you have 2 homes that you're renting out and you have 1 unit that's vacant, you're 50% vacant, which is a huge hit, and you're going to be carrying that home for 2, 3, 4 months, and it could just drain all of your reserves.
Yeah.
But if you have 4 units, and then 8, and then 12, and then, you know, as you increase those units, 1 vacancy is a much smaller and smaller percentage, or 2 vacancies is a smaller percentage. So
yeah,
that's where I would start for people trying to get in. Buy the 4 unit building in an area that you feel safe. Live in the worst unit if you're single. You know, if you're married with kids, you kind of, you know, you have to figure out what you're going to do, right?
Yeah.
But let the other people pay for your expenses. And to me, if you can have enough units that are covering all of your expenses to live, you're already financially free.
Heck yeah. And just clarification. So with the loan type, so that wouldn't be like, you're talking just a conventional loan, basically.
Yeah. So it's a residential loan on 4 units or under if you're living in it.
Yeah.
You can get, you know, 5-10% down, right?
Right.
Where if you're going, if you buy one more unit in a deal, if you buy a 5-unit building, now you're a commercial loan, 25% down. Doesn't matter if you're living in it or not. Right. Totally different loan, one different unit.
Yeah.
It's crazy.
Yeah. Nice. And if you're a veteran, 0% down. If you you got to qualify in the income side.
You get a VA loan, and my brother's. If you're a veteran, the VA loans that you can get on a fourplex, you're going to knock it out of the park. Yeah.
And would it be easier to qualify? Because I know they're income based too. But would it be easier to qualify because you have those 3 rental units?
100%. Because that income from those 3 units adds on to whatever your W-2 income is.
Nice. Awesome.
Yeah.
Awesome. Well, hey, Reid, it's been really fun. Let's wrap things up. But before we do that, where can people find you, connect with you? What's the best way to get a hold of you?
LinkedIn is the best way to connect with me right now. I have like 23,000 connections, and that's where I have all my contact information up there. Find me on LinkedIn. Happy to connect with you and happy to share any insight in whatever multifamily market you're in around the country.
Awesome. All right. Appreciate your time. Thanks, Reid.
All right, Chris. Thanks for me on.
Thanks for tuning in to this episode of the Cash Flow Authority podcast. We hope the insights shared today help you take the next step toward optimizing your finances and building sustainable wealth. If you enjoyed this conversation, please take a moment to subscribe on your favorite podcast platform and leave us a review. It helps other entrepreneurs and investors discover the show. And don't forget to catch the next episode for more insights. Until then, keep mastering your cash flow.